Right, good afternoon. I think it's about time to kick off now. So thank you everyone for joining us. This is an R&D Tax webinar. I'm Paul Mills, the MD of Absolute Recruit. We're a finance, transformation and technology recruiter. For those of you that don't know us, the webinar is going to be run by Evelyn Partners, Kanika and Barnaby, who will take over now and hopefully provide you with some insightful stuff. The webinar will run for approximately 40 minutes, at which time we'll then go through a Q&A. We've got some questions that have been sent to us already, but if you'd like to put some into the Q&A area on this webinar, feel free, and we'll try and get through as many as we can. Equally, if we run out of time, we can we'll be introing you to Kanika and Barnaby after, along with a recording of this webinar, and you can get in contact directly. Okay, thank you, and over to you guys.
Thanks, Paul. Thanks, Bobby, and the rest of Absolute Recruit for inviting us to speak today. It's clearly a topic of interest. It is a hot topic in general tax at the moment for a number of reasons, which we'll go through. We will try to go to as much detail as we can without kind of boring the socks off anyone. So as Paul said, if there's any follow-up questions, please feel free to reach out. We will be sending the slides decks round. I believe, Bobby, Paul, we're also going to be recording the session in case there's people that can't attend. There are obviously nuances depending in the sector in which you're in, and probably areas of the changes to legislation and scrutiny that probably apply more heavily to some sectors than others. So again, if you've got any specific sector questions or requirements, then just let us know or put a question in the Q&A. Kanika, do you want to jump onto the next one? Just as a very brief introduction to us as Evelyn Partners, for those of you that haven't heard of us, we were previously Smith & Williamson. In 21, merged with a business called Tilney. We were then called Tilney Smith & Williamson, and we've rebranded a couple of years ago, 18 months ago, to become Evelyn Partners, to essentially bring all services under one roof. We are the 6th largest professional services firm in the country and the 2nd largest investment management firm in the business. So we've got about 1,500 people focusing on accountancy and tax. About 60 billion under management from an investment management perspective, and a large team of financial planners. So we historically have dealt with a lot of, I guess, fast-growing owner-managed businesses, and we can service them from both a personal perspective, particularly through to exit, but also all of their corporate interests. From an R&D perspective, we're a team of about 40 people. Our team all come from various technical disciplines. We sit within business tax, so if there's any sort of more complex tax issues that might arise from our work, we have our colleagues to help us with those, but we get under the hood in terms of the activities in which our clients are undertaking. My name's Barney. I'm a partner in the team here. I've been operating in R&D for the last 11 or so years. A key focus has been on the built environment and manufacturing space for myself, and I'll let Kanika introduce her in a second. We spend a lot of time with policy, so large business and WMBC, Treasury. We've been heavily involved in a lot of the sort of consultations. HMRC have proactively reached out to us to get our advice or guidance on some of the changes recently. There's ongoing consultations which we've featured heavily in the input, and we've been referenced in a lot of those documents. So we've got a good relationship with HMRC, although it's tested sometimes, as probably most of you would appreciate. But yeah, that's a brief introduction to ourselves, and I'll let Kanika introduce herself now.
Thanks, Barney. Hi, everyone. I'm Kanika. I'm an associate director here in the Evelyn Partners R&D team. I come from a software engineering background, and so my specialism tends to be on, kind of software engineering or IT-focused businesses. And within that, I have for nearly 7 years now been specializing in any claims that are within the fintech and financial services sectors. That tends to be a key area of focus. In addition to that, I'm also the technology lead here, and so I oversee quite a lot of our, kind of client technology offerings.
So as agenda today, we thought it'd be useful to provide some context and look at what the R&D legislation has kind of given us prior to the spring budget in 23. We'll then look at the changes that have been enacted and implemented throughout the 23 period, and then looking forward to changes that are going to be happening from 1 April 24. The major change in relation to the merging of the regimes has now been signed off or enacted. However, the date in which that is going to be enforced has been left blank at the moment, so we're a little bit unsure. And we'll then talk around, I guess, the more general increase in scrutiny that HMRC has been applying to the R&D sector over the last 2 years, which some of you may or may not be aware of, but it's not pleasant when they do start to look at things in a little bit more detail and slightly sometimes difficult to get out of an inquiry. And then we'll talk about how we're approaching running an R&D claim for a lot of our clients, transitioning to them to a more real-time process from both a financial and technical data collection, and then some time for some Q&A after that. So just to provide some context initially, obviously R&D tax relief has been around since 2000 for small to medium-sized enterprises and 2001 for large companies. We're the only, or one of the only countries in the world that has 2 separate R&D schemes at the moment. And as we'll go through this, that's going to change soon. That they will be merging into a singular scheme. Over the last 20 or so years, there's been very little change. There's been ad hoc changes year on year, slight reductions and increases in rates, but broadly it's been exactly the same. And HMRC's approach to, I guess, the level of due diligence and scrutiny has been the same up until about 18 months ago. A lot of changes were announced in the spring budget in 23, and there was consultations before that. Largely, the definition of R&D for tax purposes has remained the same and is going to continue to remain the same. However, the level of documentation that you have to produce is going to increase, and I guess the administrative burden to support your claim is going to increase. And then we'll talk about around the measures have been put in place to tackle abuse and error and fraud or suspected fraud in the sector. So if we look at the rates prior to 1 April 2023 for SMEs, there is a super deduction calculation. So qualifying expenditure plus an additional 130% times by your rate of corporation tax would have given you a net benefit in a profit-making position of roughly 25%. In a loss-making position, it's the same super deduction calculation, and you can then surrender that at 14.5%, which essentially will give you a 33% cash injection, or you could use those enhanced losses to carry forward against future periods if you were anticipating profits in the near future. From a cost category perspective, staff costs, externally provided workers, subcontractors, and there are subtle nuances between those 2 categories, consumable costs and software costs. So pretty generous from an SME perspective, and the cost categories remain pretty unchanged. From a large company perspective, slightly different. It comes in above the line. Large companies prior to 1 April 23 were getting a 13% above the line credit, which was then subject to corporation tax, bringing net benefit down to about 10.5%. The difference in terms of cost categories between the two schemes is that large companies can't include subcontractor costs. And the relevance of this will kind of come to light later on in the presentation, but essentially you can include individuals that are working underneath your supervision, direction, and control, or businesses that are underneath your supervision, direction, and control. However, if you're outsourcing work and then the third party is running that sort of autonomously, you wouldn't be able to include those claims. The only additional cost category we could look at for large companies and still can is contributions to independent research, and typically there are only sort of certain types of organisations that would be making those contributions. What we have to draw on is that R&D is relevant to a field of science or technology, and this is relevant to both the SME and large company space. Things that we haven't been able to include are arts, humanities, social sciences, economics, and pure mathematics. We've highlighted pure mathematics because that is changing, and we'll go into a little bit more detail further on, but that could potentially have a good impact on financial institutions, trading businesses, being able to include quants, modelers, etc., that historically sat outside of that sort of technological development realm, which we can now sort of potentially pick up. There's also been no mandatory requirement to have any supporting documentation pre the 8th of August in 23. So you could just put a number in your CT600 and hope for the best that it wasn't picked up. But there was no sort of formal legislative requirement to submit any sort of report, although we did, and I think most businesses of any size would have submitted supporting technical documentation to substantiate their claims, but it wasn't something that was required by legislation. There have also been no restrictions to overseas costs, which from the 1st of April this year, there will be restrictions in that area. That has obviously had a lot of challenge, particularly from technology businesses, software development houses that source resource from all over the world. In our view, it's an attempt for HMRC to modernise R&D tax relief to be more fit for purpose for modern businesses. We think this is a bit of a step backwards, to be honest. A lot of large organisations and small organisations use, particularly it's sort of developers, resource from all over the world now for various different reasons. Predominantly because there's a skill shortage in that space in the UK, but also cost and commercial and regulatory reasons as well. We'll now look at the kind of the changes that are coming into effect or have come into effect from the 23 period. So those highlighted in purple are changes that are relevant for accounting periods beginning on or after 1 April 2023. So to bring that into context, if you've got a December year end, these changes won't be relevant to you until your December 24 financial period. Those in red are for expenditure incurred on or after 1 April 23. And the one in golden is the new filing requirements that's become mandatory from the 8th of August. So the ones in purple I'll cover first. So extension to qualifying expenditure to include cloud and data costs. A positive step from the revenue. They identify that cloud and data costs have become a significant overhead and cost for businesses. So if they're relevant to R&D activities, you're using a cloud environment for testing away from BAU sort of functions, you're purchasing data, for an example, those now come into play when we're looking to sort of calculate what the true cost of an R&D project is. There's also been an extension to the R&D definition, which includes pure mathematics, which we mentioned earlier, which is another positive step. The final one is an advanced notification form, and this is for businesses that have not submitted a claim before or have not submitted an R&D claim for the prior 3 financial periods. So you will now have to submit an advanced notification form within 6 months of your financial year end. Otherwise, your R&D claim will not be accepted. There's also been a reduction in rates for the SME scheme and an increase in rates for the large company scheme. And that is for expenditure incurred on or after 1 April 23. So if you have a financial period that straddles that date, you'll calculate your relevant R&D expenditure pre-1 April that falls underneath the old rates, the 130% or the 13% super deduction or above the line credit that I mentioned earlier. And then any expenditure that falls after that, you calculate at the subsequent higher rates, which I'll show you in a minute. On top of that, there's now also an additional information form. So any claims submitted post 8th of August 2023, you now have to submit via new government or HMRC gateway portal, essentially. Now, this has significantly increased the administrative burden and the reporting in which you have to do to substantiate your claim. So you have to produce narratives that cover, depending on the volume of projects, and we could go into a bit of detail on this, but I'll give you a kind of a broad overview. Essentially, if you have more than 3 projects, or if you have 3 projects or less, you have to write up all your projects. If you have 3 or more projects, you have to cover 50% of your qualifying expenditure in the form of technical justifications, and up to a maximum of 10. So if you can't hit the minimum threshold of 50%, then you produce 10 technical narratives. This also has an impact on the way in which you've got to calculate your expenditure. So a very accepted methodology in the past was a fair and reasonable apportionment of people's time, and a lot of businesses do this on a person by person basis, i.e. we think Mary's spent 20% of her time on R&D activities throughout the period, and that was generally an accepted approach. You now have to calculate R&D expenditure on a project by project basis. So when filling in the report, you have to say project X, £130,000 of R&D expenditure and for all the projects that you've listed throughout the report. You also have to report on any indirect spend as a separate line as well. So one of the reasons this has been introduced, and we've had various calls with HMRC on this, is to, one, monitor what's being submitted more closely. There's definitely going to be more scrutiny on these forms from a business perspective, but they've also been very open that they're also going to be monitoring advisors more closely. So you have to have a named director of the business on the form from the client side, and also a named person from the advisor side. And they've been very open that they are going to be using this as a tool to monitor what people are submitting from a business perspective, but also from an advisor's perspective. So it's a tool that's definitely been introduced to enhance the amount of monitoring that they're applying to R&D claims that are submitted. So on to the new rates for the SME scheme. So as I mentioned before, the super deduction calculation was historically 130%. That has reduced to 86%. The credit rate was 14.5%. That has reduced to 10%. So the net benefit, if you're a non-R&D intensive business, profit making is reduced from roughly 25% to 21.5%. And loss making is reduced from roughly 33.3% to 18.5%. So quite a significant reduction there. But we do have some additional cost categories coming in. And on the other side, there's a new scheme that's come in from 1 April 23, which is for loss-making R&D intensive businesses. So if you can justify that 40% of your operating costs are relevant R&D expenditure, then you fall within this loss-making R&D intensive scheme. And that was from 1 April 23. The threshold for that from 1 April 24 is reducing to 30%. So if you're a very R&D intensive loss-making business, you can still fall into this more sort of generous category for the SME scheme. Anyone outside of that will be under this new rates for the 2023 period up until the merge scheme is introduced at a later point. For large companies, there's been an increase in generosity. So the gross rate for RDEC has gone up from 13% to 20%. We've obviously had an increase in the rate of corporation tax to 25%. So the net benefit has gone to 15%. We're still looking at a pretty generous increase of about 50% in generosity in relation to the large company scheme. When this was initially introduced, we obviously had a reduction of the SME rates and an increase in the RDEC rates. And this was broadly, I guess, a step change or direction of travel for HMRC and the revenue introducing the new merge scheme. So we've seen a swing in the generosity of large company rates upwards and a decrease in SME rates. Moving forward, this is going to fall under one banner, and it will be the rates you see in front of you now. So we can obviously now include pure mathematics as an activity. So pure mathematics are feed into an R&D project. If you're doing extensive modeling, if you're increasing your baseline knowledge within the business using mathematics, we can include that, which is a positive thing. We can include 2 additional cost categories in data and software licenses, and cloud computing costs. There is now obviously a new way of submission that's being implemented to increase the level of scrutiny and make sure businesses are more compliant. As mentioned, this is coming from the 8th of August 2023. So any claim submitted post that, if you haven't filed it prior to your tax return and CT 600 being filed, your claim will automatically be rejected. So you'll then have to make an amendment and refile the AIF form post that. So there's also a box on the CT 600 that has to be ticked to say you have submitted the AIF form. As I said, without it, it will immediately be removed from your CT 600 and you won't receive the benefit. So it's vitally important you get this done prior to your return being filed. We're then looking at changes on or after 1 April 24. And this has been a significant areas of contention, as I've mentioned before, is restriction on overseas costs. So the Treasury and HMRC want R&D to be taking on UK soils by people based in the UK paying UK taxes. And for that reason, they've said anything that's happening outside of the UK, you will not be able to include for accounting periods on or after 1 April 24. So again, if you've got a December 24 period, year end, these changes won't affect you until your December 25 period. So although they've been implemented quickly, that does give businesses a little bit of breathing time to adapt, not as much as we wanted or proposed. But the on or after does give people a little bit of flexibility to adapt to those rules, particularly around the overseas expenditure. Now, there are some exemptions to this. So if there aren't the conditions necessary in the UK to undertake the R&D activities, then you'll still be able to claim for those costs. If there are, that can be anything from kind of geographical, climatic conditions, for example, but there's also points around regulatory issues. So this is untested at the moment, so I am going to caveat this, but in relation to insurtech businesses that have to be performing certain activities due to local regulation or policy, we're going to explore these avenues to see if there are things outside of your I guess the obvious areas, like we can't mine for a particular mineral in the UK, therefore we've got to do it overseas, or if it's just wholly unreasonable to replicate the conditions in the UK. So there are a few exemptions. Things like costs or lack of resource, unfortunately, aren't going to fall into that. So a lot of, I guess businesses in the software space that are just sourcing resource from, typically where we see from Asia, from parts of Eastern Europe, from Czech Republic, from Poland, etc., where you're accessing local talent and resource just because potentially it's cheaper or there's a lack of skills in the UK. Unfortunately, that won't fall within the exemptions at the moment. As you can imagine, this point's had a significant amount of challenges from a lot of our clients and a lot of the wider industry. Now, we're also looking at a merged scheme, as I mentioned before. So there is currently an SME scheme and a large company scheme. The transition is the fact that there will just be an RDEC scheme or an R&D intensive loss-making scheme. So most businesses that don't meet that threshold, and from 1 April, it's a 30% of your operating costs have to be allocated to R&D costs if you want to fall into the R&D intensive scheme. The majority of businesses are now going to fall under this merged scheme. So it is moving to an RDEC-like mechanism. The benefit will be a 20% above the line credit gross with a 15% net. And with that, they've also looked at a number of other sort of policy changes, which they're still under consultation. So the merge scheme has now been enacted as of this week, so it will be happening. What they have left blank at the moment is the date in which this will be implemented. So initially, they were looking at 1 April. This could be extended to 1 April 25. We should sort of, I guess we'll know more about that after the spring budget in a few weeks. But it's definitely going to be happening. There's a few contentious points that are still under consultation, particularly around the 2 points here. I mean, subsidised, not so much. So subsidised expenditure, we don't have to worry about anymore. If there are any people in the construction SME space at the moment, you'll know this has been a pretty hot topic. So for a lot of SMEs, if your expenditure was deemed to be subsidised, you would have had to have claimed under the large company scheme rather than the SME scheme. If your expenditure was grant funded or you received notified state aid for that expenditure, then it would be subsidised. We don't have to worry about that anymore. Now, the larger point of contention was around contracted out or subcontracted R&D activities. The way in which the draft guidance was initially drafted, which caused a lot of panic, particularly amongst our larger construction tier one main contractor kind of portfolio, was essentially it is the funder that is going to be able to make a claim, regardless of their technical capability in that particular area. Now, us and a lot of other businesses responded in detail to that, and the more the guidance has come out recently that's under consultation again has had a sort of almost 360 or 180 on that. Sorry. So we're now looking at the people or businesses with the technical authority on that project, the businesses that are taking on the financial risk on that project, So it's moved away from it being purely the funder that's able to claim to the people that have control over the R&D. The way HMRC have phrased this, so if you're contracted work, let's say you're a technology firm that's been contracted work by a bank, or you're a engineering firm that's been contracted work by a developer, if those people are able to contemplate and direct and specifically pinpoint the areas of R&D in which you need to undertake, then it could be your client that's able to claim for your costs. Likewise, the other way. So if you're subcontracting work out, but you have technical control over that project, you'll now be able to claim for those costs as a subcontractor cost, regardless if you're an SME or large company. That does have implications for small to medium-sized businesses that were able to claim for that, particularly if you're being contracted by a large company. So if we think about it in the contracting space as an example, so tier one main contractors that do have technical sort of authority or insight into any work in which they're subcontracting out, there may be complications over then whose R&D is that to claim. Is it the person you're subcontracting the work to, or is it the person that is subcontracting the work? So this is an area that needs to be considered in a lot of detail when you're looking at your projects, particularly if you're doing projects on behalf of a third party or you're subcontracting parts of your work out to other businesses within your supply chain. And if it falls into, you can't claim for the costs because you've been subcontracted work, that could have a significant impact on your ability to make a claim. On the flip side, if you can now include more subcontractor costs as part of your R&D claim, that could have a massive kind of positive impact on yourselves. As I said, that this is still under consultation. This will be part of the merge scheme. The finer detail on that is yet to be drawn out. A lot of the examples in which we put forward have now made their way into the draft guidance notes at the moment. So it has appeared HMRC have listened to a lot of the industry and advisors, and hopefully we're working towards a position in which it is the technical doers of the projects rather than purely the funders of the projects that are able to make an R&D claim. Here's, I guess, just a broad timeline of all the changes that are coming in. So there are initial announcements in terms of the rate changes back in October 22. The spring budget outlined when the changes will take place, et cetera, et cetera. So broadly in line with what we've spoken about so far, there has been a lot of change, and there's more change coming potentially from the 1st of April 24, potentially from 1 April 25. I think that's going to be clarified over the next 3 weeks. So I guess keep an eye on when those changes are coming in. During the last, I guess, 20 years, HMRC have been, in my opinion, pretty poor at policing R&D tax reliefs. There's been very little scrutiny. There's been a lot of advisors in the market that have been pushing businesses to make claims which frankly shouldn't have been making claims in the first place. So although the enhanced focus and the scrutiny being applied at the moment is not being administered in the right way, it was a correction that needed to happen. During COVID, they accelerated payments for R&D claims to help businesses with cash flow, which was very welcome. Off the back of that, there's been, a lot of these stats were picked up by major mainstream media outlets, and it was reported that there was sort of £1.2 billion of error and fraud in the R&D tax relief scheme. Error versus fraud are two very different things, obviously. R&D in its very nature is relatively subjective, so it's relatively easy if you wanted to find error or differences in opinion. Fraud is obviously a very different thing. Again, that's actually businesses that are being set up to make fraudulent R&D claims, faking invoices, overinflating wage bills, etc., etc. So there's been a lot of error and fraud that's been identified. I do take those numbers with a pinch of salt because error is not always a very accurate reflection because there are differences in opinion and it's subjective. What this has meant is that HMRC have massively increased the level of scrutiny. So about 2 years ago, they set up a new campaigns and projects team through the Independent and Small Business Unit. And this has basically been rolling out a mandatory inquiry program. focused at the SME space. This level of error and fraud has been very much focused on the small to medium-sized businesses, and they've been raising thousands and thousands of inquiries, very templated generic letters, nothing specific in there in relation to the projects. If you have submitted a report, no specific detail in reference to the reports in which you've been submitting, and they are being run by people that are very new to R&D tax relief, and they can be quite difficult to get out of, even for businesses that are submitting blue sky R&D projects. They're a challenging and lengthy process to try and get through. Their protocol at the beginning of these inquiries is you're not doing any R&D, regardless of the projects that have been submitted, and they're almost looking for errors and fraud to drive statistics, which is a challenge. On the other hand, it needed to be implemented to ensure there was longevity in the scheme, and the right businesses are continuing to get the aid in which they deserve. We have to consider areas of risk in this. So one area that is worth looking at for all businesses is your SIC code still relevant to the activities in which your business is undertaking? A lot of businesses have set up SIC codes at the time of incorporation or many years ago, and that SIC code hasn't changed. What we found with some of our client base is actually it's not a true reflection of the activities or the business activities in which you're undertaking. One of the mechanisms that you're using to identify error and fraud is by doing a review on SIC code. So if you sit within a SIC code that could attract more attention, you're more likely to receive an inquiry. So it's worth reviewing that and making sure that it's still applicable to your business activities as a way to mitigate risk of one of these inquiries that come up. And finally, the additional information form. So this is obviously a mandatory thing that's come in now. You have to report on your projects. You have to put in a fairly significant level of detail from a technical perspective and financial perspective. So it's really important that the detail and the information that's going into those forms is accurate, robust, and detailed enough to stand up to scrutiny.
That's a nice segue into one of the ways in which companies can potentially eliminate some of the risks associated with the collation of their claim process, and that is a transition to a real-time R&D process. And the most obvious question that you probably have is what is a real-time R&D claim? Essentially, it's a more contemporaneous as opposed to retrospective way of identifying R&D activity and tracking R&D projects as well as R&D costs as and when they're happening, as opposed to in hindsight. The idea is to kind of embed the thought process of identifying R&D within the fabric of your organization, as opposed to it being an afterthought for your technical leads. And this can be done in several different ways. It can be through periodic touch points with relevant technical leads within organizations. It can be through partially automating the claim process or wholly automating the claim process, and we'll touch upon that in a second. However, the general idea is to alleviate the burden that is placed on your technical teams of thinking about the work that they've done in the last 18 months or in the last 24 months, and sort of just giving them the opportunity to have a conversation with an R&D expert as and when they're doing the work and as and when they have a realistic view of the challenges that they're facing. Why is this important to organizations and why might they care? One of the most crucial factors is, as you can see with the bar charts on the screen, we've got a couple of case studies. These are anecdotal, but fairly often experienced when moving clients from a retrospective claim process to a contemporaneous claim process. There's often a manifold increase in the levels of R&D identified. And there are several factors behind it. The most obvious ones being, there's less hesitance from the respective technical leads to identify R&D because they're more comfortable in the nature of the uncertainties that they're facing and in the nature of the R&D activities that they're working on when they're being spoken with. Plus, also, quite often we find technical know-how can leave the business, in sectors in particular with high turnover and high kind of levels of redundancies and the likes. You might find your technical leads as well as knowledge about R&D projects has left the business. However, if you're undertaking a real-time R&D claims process, that knowledge is retained within the business, and therefore those projects can be comfortably included as part of your R&D claim. And that effectively leads to a holistic increase in the claim value, while at the same time minimizing any risks associated with including such projects in your R&D claim. There's also other factors that contribute to organizations wanting to transition to a contemporaneous approach. Some of them being, enhanced financial planning. Companies often like to have a view of the R&D expenditure that's being identified and R&D benefit that can be expected at the end of the year, which is not something that they have historically had visibility on if the claims are being done 3 months after year end, 6 months after year end. There is an audit focus as well, quite a lot of time for larger organizations. The audit team is quite interested in the methodology followed, in the examples of projects included and the likes. So there's an enhanced audit trail of all of the work that has been included as R&D eligible. Therefore, kind of, again, giving yourselves and your auditors a lot of assurance around the claims that have been prepared. A lot of our clients like the idea of having kind of a more detailed analytics around, how their claims have been prepared and the estimated R&D values. And again, I'll talk about that in a second. Without impacting the efficiency of the claim process and without further burdening the technical function with R&D work. And we've often found that in transitioning to a contemporaneous process, even though it might sound like there's increased touch points with relevant stakeholders in your organizations, there's a lesser investment of time required by these stakeholders, because they're not having to go away and kind of dig into project logs or dig into meeting logs and those kinds of things to try and I guess remind themselves of the work that they've been doing. So like I said, there's few different ways we can go about undertaking a real-time R&D claim. And this is an example of a bespoke kind of offering that we've created over the years based on client feedback. Wherein, at the front end of the technology, we provide clients with a self-service portal whereby they have detailed claim analytics and reporting available to themselves that gives them visibility on all of the kind of various, moving pieces of the puzzle in terms of the claim process. If there are multiple divisions in a company, which divisions have been assessed, what activities have been assessed, who are the assessors, what levels of R&D have been identified, et cetera, et cetera. These are drill down dashboards that I'll show a demo of shortly. And then in addition to that, there is a live document collaboration portal. So client contacts and ourselves will have access to a single instance of a particular document that they can then basically manipulate in real time with our support. And this gives quite a lot of auditing of the work that's been undertaken in the back end, both to identify the claim costs, but then also to collate the actual claim report and the claim deliverables. And ultimately, what you have accessible to yourself in a self-service manner is a full audit trail of every single piece of information that's been provided to us, who's basically signed off on that information, and all of the steps involved in the collation of the final claim deliverables. This portal is backed by several kind of tools that can be taken, piecemeal, or that can be provided as a consolidated offering. So there's RPA bots that can pull information periodically from your financial systems, which means that the kind of burden of providing information to your R&D providers is kind of taken off of your plate. We have tailored web surveys, so essentially questionnaires that are entirely bespoke to an organization or the sector that they operate in, that can be provided to your technical team to help them with the identification of R&D activities and help them with the identification of R&D costs to be included in their claims. And I guess most importantly, we believe that no technology can be kind of fully made available to our clients without our input, and so human judgment is of prime importance. So any of these tools and technologies that are provided to clients are heavily controlled by Evelyn Partners technical experts. Any information that's provided within these questionnaires or provided within these dashboards is heavily audited by our technical experts in the back end. As I said before, part of the technology offering is a drill down Power BI dashboarding capability that gives you several data cuts. It's entirely customizable. It's developed in London with support from our kind of technology transformation function. And so we're able to offer clients any, essentially trends analysis or any other analytics that might be useful to them. Two examples that I've presented on screen here that are quite popular are a quarterly analysis. So it kind of is a example of a periodic R&D claim process whereby, you know, we have quarterly studies and a quarterly estimation of R&D spend that is then presented to clients through a dashboard. All of these data points on the dashboard are drilled down, so it gives you quite a lot of detail around, you know, why is R&D declining in my business? Where are these kind of major declines coming from? Is this representative of the investment of you know, cost and resource into some of these R&D projects, and kind of gives you a lot more of a basis as to understand the trend of increasing or decreasing R&D around the business. The second data cut there is more of a CP or competent professional based analysis. So it gives you a view of, I guess, you know, technical leads or portfolio leads, and just helps you understand which portfolio leads are contributing how much to your overall qualifying R&D expenditure. Again, so if there's divisions whereby, you know, you've incurred significant R&D spend or significant technical spend during a particular period, then this gives you a basis to understand what is the return on that particular investment, and also gives you a basis to kind of see, you know, we've got other dashboards available, so it gives you a basis to see, you know, where is engagement the highest from an R&D standpoint, you know, what's kind of stalling the R&D process. So you'll have kind of drill down progress trackers available to yourselves. The idea to do all of this is not to kind of completely overhaul the organization's existing processes for capturing R&D. So the idea is always to embed these systems where feasible and where applicable into your existing systems and processes, whilst at the same time giving you enhanced visibility of the claim process and comfort that risk has been managed adequately throughout. And in saying that, it would be crucial for me to mention, you know, I've provided you an example of a dashboard, of given you some examples of, you know, other technologies and tools that are available. But ultimately, whether or not a company moves to a real-time R&D claim and how much effort that involves is absolutely down to the organization's individual appetite. So there's several ways in which a real-time R&D claim methodology can be conducted. One is, you know, for example, using the questionnaires, and you know, for large organizations this is quite useful, where you have hundreds of stakeholders, thousands of projects to be assessed, to then set up bespoke questionnaires that will be populated on a periodic basis, through which we can then start consolidating information around R&D claims and validating that information. But by no means is that the only way. So, you know, we can also have, you know, periodic touch points. So every quarter, maybe a 10-minute conversation or a 15-minute conversation with relevant stakeholders to try and start consolidating R&D project information, so that at the end of the year, it's a case of kind of polishing that off and converting that into a deliverable that can be presented to HMRC. There's also ways in which we can extend existing systems and processes. So in particular in the fintech sector, quite a lot of organizations rely on project tracking tools such as Jira and also, you know, Confluence. And so, you know, we've often helped them build a methodology through which Jira tickets and Jira epics can be flagged in real time as being potentially eligible for R&D, and then we kind of validate them on a periodic basis with their technical leads, which means that instead of being kind of, you know, a major step change for the organization, it's a minor addition to the existing project tracking processes, through which they can then kind of, you know, have a more realistic view of R&D throughout the year. And there's also obviously all sorts of, you know, periodic planning sessions, you know, technical stand-up discussions, capitalization assessments, etc., that we can tag ourselves onto, organizations can leverage to start thinking about what's been planned for you know, the next quarter or the next half year, and what has been done so far in terms of R&D. Right. I believe that takes us to the final segment, and I do think that we have a few questions that have been posted in the Q&A section. Maybe we can start working through those one by one. So the first one that I see there is on the advanced notification. If it is a pre-notified through previous CT600, is that still required? Barney, do you want to take that?
So the advance notification has to be submitted within 6 months of your financial closing period. And this is only for businesses that haven't submitted a claim in the prior 3 periods or haven't submitted a claim at all. The mechanism for doing that, we haven't actually filed one yet because most of our businesses are actually, they've been doing R&D claims for a long time. Kanika, is there a separate portal for that? Do you know, or is it a notification on the CT600?
I think there's a separate portal, and I do believe that some in the team have only this week filed the first one. So yeah, it's separate to the CT600. Okay. So the second one there, when you refer to a project, is that different R&D projects, or is it within one project, the different work streams or phases of an R&D project? That's a really good question, and quite a interesting area of the legislation. So, in terms of the way the HMRC have worded the legislation and their guidance, there is no definition of what a project is. And so in principle, an R&D project in practice could differ vastly from what is considered a project for commercial purposes. And the idea is for any R&D projects that are included in the claim to be as representative of the underlying technological uncertainties that were faced as part of the project and the underlying R&D activities that were undertaken within that project. And so I guess the answer could be either or, depending on the individual organization, how their R&D activities are kind of classed, whether the projects for commercial purposes are actually neatly aligned with projects for R&D purposes, or if there's maybe a broader theme of work that's representative of R&D activities that isn't strictly, considered a commercial project in its own right. So it could really be either of these.
Believe there are a few questions sent through before the webinar as well. I think that the first one.
Sorry, Barney. I'm just gonna sort of add them into the Q&A just so everyone can see the questions.
Cool.
I've just added one in, which I think you did answer during the presentation around the sort of pro rata, but yeah, I'll let you guys take that over, and I'll start adding the other questions in.
To extend your end. Yeah, I mean, so a lot of these changes are happening either for accounting periods beginning on or after a certain date, or it's expenditure incurred on or after a certain date. So if it doesn't really have any benefit to extend an accounting period, I think there are going to be certain measures put in place to stop businesses kind of artificially extending an accounting period to get any benefit from any of the points. So it wouldn't be advisable to extend an accounting period purely for the purpose of trying to kind of extend any sort of particular benefit in relation to R&D at the moment. The second point is around, I guess, the overseas costs, where obviously this is going to have an impact for a lot of businesses in the not too distant future. So probably from the 1st of April this year for accounting periods beginning on or after that date. So it's going to be if you are subcontracting development work to places like Pakistan purely because you can't find the resource here, or it's cheaper to do so in those sort of countries, then unfortunately that probably will be a cost that will be impacted by these new rules. I think the next question was of a similar ilk, I think. We've got quite a few clients, as I mentioned, in the sort of construction space. I mean, so we deal with very large tier 1 main contractors all the way through, I guess, the supply chain, and that includes precast manufacturing facilities. So if you're looking to develop new processes for manufacturing, you're looking at changing the concrete mix to lower embedded carbon within your products. If you're looking at systems that are challenging in their nature, that they're not readily available, they're not solutions that you can roll off the production line and go and install on site. You've got to kind of redesign certain products you're developing depending on the product. Then yeah, it's definitely worth exploring those. Particularly if you can go into, I guess, prototyping, trialing of a potential manufacturing line where you can start to include all the kind of the operators costs on that, utility costs, consumables, scrap costs, etc. So definitely worth having a think about if you're in the concrete products, so construction sector. Any more? Was that it, Bobby?
Just one more I've just posted, Barney.
Would you advise companies? Yeah, I mean, so I mean, moving forward, the difference between an externally provided worker and subcontractors is not going to have the same relevance as had in prior periods. So IR35, when we're looking about if we're looking at EPWs or externally provided workers in the past, these are individuals typically that either work through their own personal service company, or they come through an umbrella company or a recruitment agency, etc. And these individuals don't sit in your payroll, but also act as an integrated part of your teams. When IR35 was introduced, this caused a lot of our clients and businesses in general to be slightly concerned about including high EPW costs within their calculations, particularly if they're individuals that have been with the business a long time, because that then may have an impact on IR35 regulation. Moving forward, the fact that we're just looking at outsourced work, and there's not so much of a distinction between whether it's an individual you're kind of integrating your team or it's a third-party business, it's not going to become so relevant. In reality, we haven't really seen any conflict between IR35 and externally provided workers, so it hasn't had a huge bearing.
Perfect. I don't know if we want to open it up to the floor. If anyone else has got any other questions, feel free to unmute yourself and ask away.
If there are any follow-up questions or anything kind of comes to mind afterwards, then Bobby's got our details, or we'll send on the slide deck, and if there's any follow-ups, then yeah, just please let us know.
Yeah, what we'll be following up, as Paul mentioned earlier, we'll be following up with a recording, and we can share the slides with everyone, and yeah, share Barney and Kanika's details so that you guys can reach out directly if you do have any specific questions, or I can share any questions with them. But yeah, we'll also try and collate some useful bite-sized bits of information that we'll sort of periodically sort of share for, sort of via social media and other sort of marketing. Yeah, over the next week or so. Something that we are looking to do is actually partner with Evelyn Partners and other providers to look at other sort of webinars in the future. So it's something that we're going to be looking to host sort of quarterly webinars on different topics. As Barney mentioned earlier, they've got a professional services team and also the investment arm. So yeah, that we could be able to sort of get some of their investment team on a call to actually discuss some of the challenges around fundraising and what have you. So yeah, we'll keep everyone posted on other topics that are going to be coming up. Paul, I don't know if there's anything you've got to add.
No, just a thank you to Kanika and Barnaby for hosting. It was very insightful, and as Bob said, I'm sure they're happy for anyone to reach out directly if anyone's got any further questions. But no, apart from that, just thank you everyone, and enjoy the rest of your day.
Thank you all. Thanks Bobby
all.
and Paul.
Okay, goodbye all. Thanks a
everyone.
lot.
Thanks.
Thank you.
Bye. Really helpful. Thank you so much.
Bye now.
Bye.
Thank you. Super helpful. Thank you.